Savita, great to have you with us as always. Just walk me through your thinking at the moment.
Yeah, so we're relatively neutral on equities at this point. I don't see the market collapsing, but I don't know if there is as much upside to equities as there was at the beginning of the year. Here's the thinking. So we've got valuations that are relatively normal. They're not telling you to buy or sell. They're kind of hitting average levels. You've got earnings growth for this year. I mean, we're a little bit more optimistic than the street for this year. We're a lot more pessimistic than the street for next year. So, we think that what we're going to see over the next 12 to 24 months is some margin compression from rising cost pressure. And we really haven't seen companies able to price aggressively. So I think that's a factor that we're building into next year's earnings forecasts that the street isn't. I just want to point out two numbers to you. So we are looking for 6% earnings growth for next year. Bottom-up consensus is looking for close to 12%. We're at half of the growth expectations of the street. And I think what's missing from your average bottom-up analyst is the idea that margins are likely to compress, that we could see a little bit of a slowdown in some of the positives that we've enjoyed over the last, let's call it 12 to 24 months. So I think that the real downward revision cycle is going to start for 2020 earnings, and that's where we're a little bit worried. Now, what would make us more bullish? So G20 was incrementally neutral, I think. What would make us more bullish? We're starting to see the ISM data tick down. Those are highly correlated to earnings. If we see a plateau there or a trough in ISM, I think that would be a positive. For 2Q, it was interesting to hear the comments earlier. So guidance has been a little more negative than positive, but just remember, guidance has been very sparse over the last month. So I don't know if I would draw a really strong conclusion from the numbers that we've had over the last month, just because we've had very few instances of guidance for S&P companies relative to, the average amount of commentary. But look, I think where we are right now is an environment where sector rotation is much more important than just buying or selling equities outright. And I think that where you can find real value in the S&P 500 right now is if you steer away from the most bond-like sectors like utilities, like consumer staples, which have re-rated and gotten very, very expensive, and you look for high quality amongst the more cyclical areas of the market.
Well, let's add an extra layer to this, Savita, just to jump in. I know you've looked at the valuation of high beta and low beta stocks. Where are we now? What is that ratio like at the moment?
Off the charts. We're at record levels of investors paying a premium for so-called safety in low beta stocks. So I think we're right now at a point where low beta stocks are trading at almost double the PE multiple of high beta stocks. And this just doesn't make sense unless we're entering a recession. So the market is essentially pricing in recessionary multiples for defensives versus cyclicals. And we think that that's incorrect. So like I said, I'm not bearish on equities. I don't think we're entering a recession, but I do think that the upside to the market is limited if the bulk of the market is made up of today FANG stocks and defensives, and those are areas that might derate. So the way I would play things from here is not necessarily just asset allocation, but really sector allocation. And some of the sectors we really like are financials, which is a classically high beta sector, but has actually shored up a ton of capital on its balance sheets. Post the stress test, these companies are meaningful cash return stories. I think they deserve a higher premium than what they're getting. They're becoming utilities-like, essentially. So I think there's lots of opportunities within the market to make money. It's just at this level, I think the upside risk is potentially higher than downside risk, but that's not necessarily where you're going to make the most alpha.